Gina, where are you on that relative trade between value, growth and momentum?
So we've been overweight value really for several months now. And if you look at what has been driving that, initially it was concern about how long the pandemic would last. Now, I actually believe that the rise in rates is actually pushing investors to really think about where to find growth at a reasonable price. So I think this is really kind of garpier than pure value. I don't think that folks are interested in catching falling knives. And so if you look at the value side has just outperformed growth. And I think that really has been about trying to find better value of companies that can participate in the reopening trade. And everybody agrees that this reopening trade probably could be very big.
Even when it comes to growth, Jason, not all growth is considered the same, right? You've got tech names like Apple and Facebook, and then you've also got names like Zoom and Peloton. Are there any of those trades that you should be in? Do you distinguish there between the high growth momentum names and the mega caps?
Without a doubt. So, when we think about growth, we put them in those two different camps. Obviously, there's the high flyers, the Zooms, the Pelotons, and some that we like right now, which are Twilio, Square, and PayPal. I think that's a different camp. Obviously, we've seen the rates move from 0.90 to up to 1.75 over this past week. And obviously, a lot of the high flyer names with those crazy PE ratios, they're obviously vulnerable to this movement. But on the other side, as you mentioned, the stronger growth, like the Microsofts, the Googles of the world, those are some of the names we've kind of leaned to and added capital on some of the pullbacks over the last couple of weeks.
Richmond Fed President Tom Barkin, who is a voting member of the FOMC, joined us last hour. He struck an optimistic tone about the economy. Here's what he said.
There's a lot of momentum in the economy right now. I think we're going to have a very strong summer, a very strong fall as pent-up demand comes back in the economy, as vaccines roll out. And I think the economy is going to be strong enough to take somewhat higher rates.
Gina, that's going to be the thing, right? Because he also echoed exactly what the Fed Chair Powell said this week, which is we're going to make our decision based on data, on inflation, not on forecasts. And we're not in any hurry. We're not pre-committing anything on rates and on talking about tapering. Is there a conflict there from what's happening in the bond market right now?
Well, I think that what Fed Chair Powell has said, and I think what is worrying the markets, is that the Fed is not just looking for data to support that inflation exists, but he looks for persistent inflation now. The new Fed framework really is going to require 12 months of observed inflation, which it's been a decade since we've seen inflation like that. And so if you look at how long it will be before the Fed will finally move, it could be sometime in mid-2022. And I think that the bond market is looking at two things. One, the sustainability of debt issuance. That's one element. And how much inflation is going to be sort of generated through this post-pandemic boom. Now, our estimates are that, we're likely going to see some short-term inflation, but it won't be persistent. And that it will be a while before the Fed actually acts. But the bond market is pricing as though there's going to be more inflation than that.
Shepard Smith here. Thanks for watching CNBC on YouTube.